Hey everybody, welcome to this free edition of our Trader Use Group Weekly Roundup for the trading weekend ending September 15th, 2023. I'm Preston Brent. Thanks for tuning in. Well, these markets seem to be giving a lot of investors a little bit of motion sickness, or as I like to say, seasick. Let's take a look at where we've been and where I think we may be going here short term. So if we take a look at the indexes, you can see that mostly in the red for the week. S&P, NASDAQ, Russell, all in the red. Year to date, very healthy, very strong. Dow is the only index in the green, but just barely. Mostly value stocks led the way, and the Dow tends to lead the way when that scenario pops up. Year to date, everybody's solidly in the green. Um, we had a technology show by Apple introducing their new iPhone, and that really didn't, appease the markets that much, even though Apple has a big percentage of the index value of the S&P or the markets, but really didn't impress that much. They put a little bit of a price increase on their top of the line iPhone 15s, but didn't really do that much for the markets. You can see on the right-hand side of the screen, the PE ratio, I still think, even though it's flat from the 12-month trailing to the 12-month forward, it's almost equal, but it's over 20. I think it's still a little bit high given the current interest rate environment that we're in right now, meaning 5.25 to 5.5%. Dividend yield at 155, 10-year Treasury at 432. 10-year Treasury is about 277 basis points higher than the dividend yield, and then you could see the earnings yield for the S&P up at 4.94 percent, and that is about 62 basis points over the 10-year Treasury. So that does attract some money in the equity market, and it's giving you a real yield over the interest rate of about 1.34% or 134 basis points. And you can see the VIX finished the week essentially flat. I mean, it actually fell maybe 5.05, but essentially flat for the week. We did see some interesting numbers come across. This past week is very eagerly anticipated the CPI data. Okay, it showed the Fed's is still making progress. Inflation is coming down, but we're having a little bit of a counter-cyclical move. The headline CPI number showed the largest monthly increase since August of last year, mostly because of higher gasoline prices. So a big key is how long will higher gas prices, oil prices stay up there. I believe they're going to stay higher for longer. We'll see. And then the core CPI increased slightly higher than expected, okay? But the markets seem to take this in stride, realizing that we're towards the end, if not at the end of the rate hike cycle. And now it's just a wait and see pretty much on where the Feds will take the interest rates in 2024. And then finally the PPI came in line at expectations. Retail sales were strong, so the consumer is still willing to spend, and that's holding up the markets. Okay. Now, keep in mind that we got the Fed's meeting this coming week on the 19th and 20th. 20th is when they release their interest rate projection in September, and the odds, the markets heavily favor no rate hike in September. But surprisingly, about five times higher percent chance of a rate hike in November. Almost 45% chance of a rate hike in November, but like about a 7% chance of a rate hike, 8% chance this September. And we did see the VIX this week, as you can see on the screen there. It was mostly flat for the week, but intraday during this past week, it hit its lowest point since the onset of the pandemic in 2020. So this is, as I tell our members, a really good time to start looking at hedging, because you want to be picking up hedges and puts when they're cheap, not when they're expensive. So all in all, you can see the markets in the U.S. are still the consumers keeping it strong. And then best sector performance for the week, surprisingly, utilities, 2.92, but it's also bringing up the rear as the worst performer year to date. And then technology was the worst this past week. It tends to fare much worse in a higher rate environment. Communication services bringing up the lead of the pack for the year-to-date performance, a little over 24% for the year. So we've got all in all a real interesting market right now. And we're going to get some direction out of the Feds next week. I'll show you the charts here in a minute. Meanwhile, if I introduce the European markets, and then we'll talk about them, and then the Asian markets. Over in Europe, everybody was in the green for the week. A little bit different than here in the US. The Euro stocks, FTSE, CAC 40, DAX, all in the green year to date, all in the green. And this is after the ECB raised their interest rates for the 10th consecutive time this past week. But they kind of hinted when Christine Queen Bee Lagarde, the ECB president, basically indicated that even though a solid majority of the policymakers backed that quarter point hike, so now their key deposit rates at 4%, they basically said that, intimated that that's kind of where we are right now, and it could be nearing the end of their monetary tightening. So that tended to help the markets at least breathe a sigh of relief, and then look at the future as interest rates staying steady, coming down, and inflation coming down. Okay. Meanwhile, we did see that the industrial production across Eurozone also weakened a little bit more expected in July, dropping about 1.1%. Okay. And the European Commission also cut its forecast for GDP growth in the entire Eurozone in 23 to 80 basis points, and that was from an original projection just a few months ago of 1.1%. So still in the green, but almost flat for the year. And they also projected on the backs of that the German economy, which is the largest in the Eurozone, would shrink, actually move into the red 40 basis points. All right. Previously, they'd said it would finish just barely in the green, 20 basis points, but now they're saying it's going to shrink. So that's going to hold back the Eurozone. And meanwhile, if we take a look at the UK, their GDP fell 50 basis points after rising 50 basis points the prior month. So not much of a change there. And then if we just switch over to the Asian markets, you can see the Nikkei up strong for the week, almost 3%, 28.7% for the year, which is just a huge number for Bank of Japan, or for the Japanese economy. And the Bank of Japan governor Ueda suggested that their central bank could have enough data by year end to judge whether wages will continue to rise, or and which would help them determine what are they going to do with their negative interest rate policy. They'd like to get out of it, but they're leaving it in now. They're stoking the flames over there. They're trying to drive inflation higher for longer because they've never had inflation in Japan for decades. So that's what they're trying to do. Meanwhile, all of that effort, all of that fiscal craziness that the Bank of Japan is doing over there, the yen is right at about 147 to the dollar, right? So you've got very low negative interest rates in Japan. In the US, raising rates, that has pushed the yen to hover around its lowest level in almost 30 years, 3 decades. So I do believe the yen is going to be ready to make a good run higher over the next couple of years. Members, we'll stay tuned on that, and I'll review it Sunday evening again, but I think that's going to be a really good opportunity, good trade opportunity, a long-term trade opportunity, not just in and out. Meanwhile, in China, you can see both China and Hang Seng finished in the green for the week as well. Only Hang Seng is in the red year to date. But over in China, they're not doing that good. Although we did see a little bit of a bounce in data provided by the Chinese for August, a little bit of stabilization, but it's just been going down dramatically. But we did get some stabilization in their industrial production numbers and their retail sales. And consumer prices is kind of returning back to just a little bit of a growth after falling into a contraction in July, right? So I think July's CPI was a negative 30 basis points, and then August it came in at 10 positive basis points. But for all practical purposes, it's a dead economy over there right now, right? The People's Bank of China cut its reserve ratio by 25 basis points. That's how they inject money across all their provinces into their country. So while just about every country on the planet is raising rates, the only two that are stimulating their economy and cutting rates or leaving them very low is China and Japan. So Japan seems to be out of their funk and doing very well, as you can see, but China is not. And we'll see how that shakes itself out. What I'm going to do is I'm going to switch you guys over and let's go take a look at the E-mini S&P 500 futures. Let's do this right here. And then what you're going to see here is the S&P first, okay? It'll take another 5 seconds to come up on the screen for you. So now what you're looking at is the S&P 500 E-mini futures. You can see I had a target over here of around 46.67, but it's going to take a catalyst to get up there. You can see my original pullback target. You guys that have been following me know that I've been calling for a pullback in August through September. That's kind of the higher risk time for the markets. It also happens to be the higher risk time statistically as well. But it was due for a little bit of a pullback. We blew through the 50 EMA. You can see this gap up here, but this gap is merely just reflecting the rollover from the September to the December futures contract. And typically when you have that kind of gap up, when the markets have been at or below the 50 EMA, you come back and retest that 50 EMA. And you can see that candle there on Friday. If we hadn't had that down day like that, all the markets would have finished up for the week. Because all the markets were down hard on Friday. But if we hadn't had that hard down move on Friday, the markets would have been up for the week. But again, just like being slightly below water, it would have been slightly above water. But I do believe it's a higher likelihood of testing at 50 EMA, sitting around 44.71, which is not that far from where we are right now. In order to get a catalyst to move higher, we're going to need to get positive news out of the Fed. Or let's say it another way, the market's going to have to interpret the news out of the Fed as positive. So I'm really more focused on a couple of things right now. Not so much will they hike, will they not hike this September? I don't believe they will. November, I don't believe they will either, unless the data changes. But more important, how long will they leave the rates this high? That's where I'm focusing a lot of my attention on. So we're going to get their summary of economic projections, otherwise known as the dot plot. And we're going to get an idea of just what's on the minds of the Fed voting governors and where they see interest rates in 2024. Remember, there's been a dichotomy with the bond market and the Feds. The Feds have been winning that argument so far, which is unusual. Usually the bond market ends up winning. Bond market is saying they're going to cut several times next year. The Feds are basically saying, I wouldn't say that. So that's going to kind of determine, because we're going to get that. We generally get that summary of economic projections in the dot plot at quarter end meetings, and that's what this meeting is, quarter end. So that's going to go in a long way of either boosting price action and moving us up into new 2023 highs, or taking us below the 50 EMA and moving us down around the 200 EMA timeframe. You can see we hit my short-term target, we hit my longer-term target nicely, and this target here is out to the middle of October, and it's suggesting a reasonable projection of 43.27. And I could see that. I don't see us breaking the 200 EMA and going lower. I do see us coming down towards that range, i.e. breaking the 50 and going lower. Now, if we get positive news out of the Feds as interpreted by price action, we can bust out of this sticky zone here, this shaded zone here, and run up higher. And this shaded zone is roughly around 45.50, all the way down to about 44.80, 44.90 area there. So we break out of that to the upside, that'll be the catalyst out of the Feds. If not, we're going to go lower. So that's a little bit about what I'm seeing there in this action. If we come over here and we look at NASDAQ, now NASDAQ had an ugly day on Friday. Okay, you can see here my target for NASDAQ, both short and longer term, we haven't even approached yet. We've approached them and hit them in the S&P, but NASDAQ, I'm calling for a little bit more of a pullback, because most of the tech stocks just do not like higher interest rates. It changes all the discounted cash flow models, and it really mucks it all up. Okay. And I know there's a lot of debate right now, and a lot of the analysts are saying, well, some of the tech stocks now should be considered growth stocks like Apple and Microsoft, as opposed to tech. Excuse me. So I don't know how that's going to play out, but we'll see. how it moves, but I do believe longer term, the odds do favor NASDAQ pulling back a little bit more. And then the degree to which other stocks pick up the slack, because remember, the tech stocks run a big percentage of the index weighting of the S&P. We'll see how that moves itself out. But we're going to get a lot of tell here this next Wednesday. All right. I mean, we're going to get a lot. And then, of course, if we look at the Dow, it's only one in the green for the week, but just barely. Friday, it gave it up. It gave up a lot, but we're over the 50 EMA. Okay. And all of the indexes, except for the Russell, were over the 50 EMA. But you can see here my pullback estimate for the Dow. We actually went lower than my estimate here, and then here we go right here. Right around 34,200 is kind of a pullback point, which would also imply breaking the 50 back to the downside. Okay. And then really the only index that is below the 50 EMA is the Russell, right? And if let me just find the Russell on here. I know it's around here somewhere. Here we go. If we look at the Russell, you can see here the 200 EMA is holding us up, and we're hitting my longer term target. You can see that red circle there. That's where my longer term target was, which happens to also incorporate the 200 EMA. And you can see where it's holding us up. It held us up right here. It's like a bug zapper. It would break below it, and the next candle it would move up. Then we'd move below, and then the next candle would move up. Below, and then up, away, and then it could not hold a 50 EMA. Notice the 50 EMA is moving on a trajectory to the downside. The 200 is slightly flat. So we got to see how this resolves itself, and that'll also help gauge where the markets want to go. And then, of course, if we look at volatility, if we take a look at the VIX, let me just see if I can find this VIX on here. Here we go, right here. So if we take a look at the VIX, you can see here that on Friday we were actually down 1290. We haven't been this low in quite some time, and then we moved back up. As I said before, when you get down in this range down here, the odds do favor a little bit of a pop in the markets, and this is the way it's been trading since the COVID panic. Way back when, several years ago. So this is a little bit about what I'm seeing here in the VIX. I do not see, if we look at the front month skew, you can see in the front month skew, we're green. If we look at the back month skew, you can see we're also in the green. And then if we look at the October over April spread in the vol futures, very well in the green. So the markets right now, to me, are just saying any pullback here is going to be more of a revaluation than something's wrong with the economy. All right, a reval because the PE ratios are over 20. And in this high interest rate environment, eventually that's going to start to stick. You're going to see the consumers pulling back just a little bit on spending. Profit margins going to start to fall a little bit. Top line sales are going to come in a little bit. And then you're going to see a little bit more of a revaluation in the markets. Okay. If we look at the treasuries, you're going to see here on the treasuries, here we go right here. Interest rates moved up. The bonds are back down again. We're going to be hovering around these low areas here, but I do like bonds eventually back to the upside. But I would not trade bonds a few days prior to the Fed's meeting. It's just a suicide trade because these things will take you out any which way. It depends on what they want to do, what the Feds want to do. So you get a lot of activity in the bond market. Same thing with interest rates. Interest rates go where the bonds go. Bonds drive interest rates. And you can see the rates are up here near these highs here. Now, the chart would indicate that the rates are going to roll over. All right. Doesn't mean we may not get another final pop higher, but the charts here indicate to me that the rates are about done at this high side, and they may start moving back down again. All right. So that would mean the bond market playing it to the long side would make sense longer term. And of course, if we look at currencies, if we look at the US dollar, it was a little bit flat on Friday, but look at this move. I mean, we've just had a strong move up with the dollar. This would indicate to me, expect a little bit of a pullback and then a final move higher, and then we're going to roll over. So short term, neutral to bullish the dollar. Long term, meaning for over a year, I think the dollar is going to be a lot lower than where it is right here. So those of you that want to go to Europe or use the dollar, it's going to be a nice move for you short term, all right? Because the dollar is going to be stronger. And now with the euro, I think longer term, I am going to be bullish. The euro short term, I got to see the euro repair the damage that it made from that high point right here. Remember, the economic data I read out to you on Europe, they've got they had the 10th consecutive interest rate hike, the ECB did, and we're seeing that industrial production is weaker. Germany, their GDP is now going to move into the red, and Germany's the biggest one out there. All of Europe is a big export type of environment, mostly to China. And because China's imports are down dramatically and China's got a severe cold, well, they're not buying as much from Europe. So automakers, manufacturers, all those in Germany and other manufacturing production areas throughout Europe are taking a hard beating right now. So that's why Europe and the euro is having a hard time. Eventually, that's going to come out of it. And members, we'll be looking. We've had 2 entries in the euro in 2022. I'm sorry, 2023. Both of them made really good money. I'm looking for another entry, but I don't see it just yet. When I do, I'll let you guys know. Members, I'll let you guys know. Gold, well, gold is just in a funk, and we got a way to trade gold. You can see here it's just doing this camel move, Loch Ness monster up and down out of the water kind of thing. So we have a way to trade that. In fact, my projection for gold is to move lower. I don't know if we'll get down here below sub 1900, but we've been close, right? We got down to about 1900.60 cents back on June 29th. And then we've been trying to get elevation, but we cannot get over that 250 EMA, right? So, and same thing with copper. Copper goes where China goes. You can see here we're finally starting to break out of the 50 and the 200, but it may run sideways for a while. Contrarian trade would be to be long China and be long copper. That would be a contrarian play right now. And I rather like that, right? Be an interesting play. So that's a little bit of what I see in the model of precious metals and the metals market. And then, of course, if we look at oil, I told you guys oil was moving up, right? I mean, that was a low-hanging fruit type of trade. Oil is now sitting at $91 a barrel. This is why interest rates short-term have moved higher. You can see here, my projection for oil was up around 95, all right? We're now, we closed at 91.20. I don't think oil's got too much more oomph to the upside. There is no divergence here that suggests any dip in oil is going to be bought. The Saudis are doing their best in their production cuts, and our president Sippy Cup Joe is hindering U.S. oil exploration and drilling. So it's a double whammy here, and that's going to add to inflationary pressures as oil and gasoline prices, especially diesel, stay higher for longer. If we look at nat gas futures, well, again, you can see here, this has just been a steady stair state. We've been doing bull put spreads on this thing the whole time. It's a great trade, and it's staying right around the lower boundary of this regression channel. It's starting to get a little bit elevated here, but still, bull put spreads work well, have been working well, going all the way back to April-May timeframe in nat gas. So things are looking nice there. All right, everybody. This week is going to be a big week for the markets. We're going to get an idea on the summary of economic projections, where that dot plot is. That's what we want to watch. I'm not expecting an interest rate hike on Wednesday, but I want to see what their thinking is, they meaning the muckety mucks, the feds, and what Boom Boom Powell, the chair of the Federal Reserve, are thinking for 2024 and their interest rate hikes. All right, everybody, have a really great weekend. Members, I'll see you Sunday evening for our weekly market watch. If you're not a member, highly encourage you to come in. We're having a lot of fun, and we're making good money this year. Take care, folks. Ciao.